That was the origin, right? Allowing individuals to write smaller checks, get in on those rounds that you've never been able to get in on.
Exactly. So if you take a step back, like, why do we invest in the first place? We have a vision for the future. We think the future can be better than today. We don't want to save, we want to invest. We think investors are optimists, savers are pessimists. And so what we started to do is say, let's democratize access to an asset class that has been previously limited to really large pension plans or really large endowments. Let's make that available to an average retail investor. That's what we started on. That's what we focused on. In the last 24 months, we've seen that proliferate. There's a lot of different companies that are offering access. What we realized, though, when we got really deep into it, is that it's actually the tooling that is completely broken. So as an individual investor, it's basically impossible to manage your capital calls, your performance reporting, your tax documents. And if you're an individual investor in multiple funds, logging into multiple portals, it's an absolute disaster.
But what does an individual investor look like? Private equity aside, which has kind of been hurt by rates, everyone's kind of clamoring for the private investor as an LP, high net worth individual. Who are you talking about here? The everyday person or the multimillionaire?
We're talking about accredited investors and above. So the SEC defines that as $1 million of net worth or $200,000 of income. And what's beautiful about this is the demand is coming on both sides. So not only are individual investors looking to allocate more capital to alternative asset classes, the funds themselves are looking for more retail investors. So if you look at KKR, they said they expect 40% of their subsequent capital raises to come from individuals. Same with Carlyle, same with Blackstone, same with TPG. And so the funds are looking for a match on the retail side. But our view is that the products, the tools, the solutions need to be dramatically improved in order for retail investors to be able to invest in these alternative asset classes.
So you're talking to individual investors. You're also talking, though, to GPs and indeed the administrators of the funds. What are you hearing from them? How quickly are they onboarding with you?
So far, very quickly. It's incredible, the GPs, you know, the LPs, like I'm an LP in 5 different funds, but I have a full-time day job. People who are GPs in funds, they have their entire net worth tied up in the carry of their own fund. And they have no idea what is that fund marked at. What are the significant companies? What are the marks to those individual companies? And these are people that are saving for their, kids' college tuition in the future, but don't know what those portfolios look like. And so what we did is we built a product that helps GPs, that helps LPs understand what exactly they're exposed to, what are their MOICs, and helps them look at analysis that they have never seen before when they were just downloading a PDF or a capital account statement from an antiquated portal.
You have raised money, of course, yourself, not only managing the money of others. How is, your own business been going in this, what has been a more difficult environment? Have you been having to focus on ensuring that you're revenue positive, profitability a focus, and indeed, are you looking to raise more money?
We have managed quite well. I mean, look, this is my second time around, and we have a team of exceptional co-founders I have and investors, so we have lots of runway. The company's been performing very well. My view on raising capital is raise as much as you can whenever you can, but in the market today, it just doesn't make sense. So when the market warms up a little bit, obviously with the 10-year at 4.7, where are we going to get VC dollars from that are not obscenely expensive, right? So our view is perform really well, the market will warm up, and then we'll go raise capital opportunistically. You never want to raise capital when you need to. You raise it when you want to. And right now, we neither need to nor want to.
Ethan, what is it that the Coterie has, technologically speaking, beyond a database? Are you a tech company?
We are only a tech company.
How so?
We don't employ advisors, for example. We don't employ anybody who is not a software engineer. The advisory model, even in fintech, in new wealth tech, doesn't really work because people are not looking for a commission-based structure or even an AUM-based structure. What you'll find with a lot of wealth advisors or even some of the larger folks, you saw Goldman reported earnings this morning, what they're saying is, we are going to try to get you to give us your alternatives as a management so that we can charge you 50 bips on it. But there's no need to charge 50 bips on something where you're paying capital calls and reporting on PDFs. That's why our payment structure is fixed. We charge a fixed $100 per year per fund, regardless of how big the structure is. So the way that we can do that is by having software, right? If we had people behind us, it would be incredibly expensive, and there's no way that we could deliver that product. The only way we can do that with the significant margins that we have is through software.